Hey, it's Soleil in this episode 331 of the Orange Pill Investor. I think I probably forgot to share. So let me try to get that going. Little technical difficulties today. It's a day off, so I think I'm in vacation mode. What's up, Rob? All right, so today I want to talk about my exit strategy, pun intended, and also a poll that BTC Pikachu put out here. Will MSTR HODL only strategy outperform selling covered calls in 2025? I answered this too quick. I actually said no because I thought most people running a covered call strategy will probably fuck it up somehow. And I forgot to read the fine print, which was 7-week at the money calls. So that's 42 days to expiration, which is pretty close to the optimal 45. But optimal at 45 is actually for out of the money calls. And he's specifically specifying at the money call sold at peak vol and near all-time highs and ignore taxes. So the way that he's laid it out, it probably should have been a yes, simply because if I just look at a year's worth, I mean, you'd have to ignore when they IPO'd for all-time highs, but like, I don't know, if you were hodling at $15 a share. And then what? I guess if you doubled your 15, you'd call that an all-time high. What is this? 27. So yeah, like at $30, that'd be an all-time high. But then you might, if you sell at the money, that's going to be $35, $40. And from here to here, it doesn't go down to 35 again from December 2020 to January 2022. So no. I mean, I guess you would continue selling all-time highs till you get to 75, but how would you know this is the all-time high? I guess you'd sell it again at 75, and then it just wouldn't go to 75 again to here. So you sell the 35s, then maybe you sell the 60s, and then you sell the 75s. You lose on the 30s, you lose on the 60s, you win the 75s, and then you stop selling covered calls from February 2021 until January 2024. You just don't sell them anymore. And then you get an all-time high here at like 170, but I'm sure somewhere along the lines at the 100 strikes, you're going to sell them. You sell them at the money, kind of break even if you hold till here. So I don't think the way that this is laid out would actually work. So my no is probably still accurate. Um, it's laying it out mechanically, which already puts you at a disadvantage, but it's also specifying something that's very hard to do because, yeah, you'd be selling them at 178, but 117s are not all-time highs, and these 150s are not all-time highs, so you're not gonna make any money from 150 down to 120, and then you're not gonna sell them again until it gets to, like, 230. Um, but if you combine that with peak vol, that might work. If you say, okay, the baseline vol on MicroStrategy is approximately 60, 70-ish, maybe and then boom, if I vol if implied vol doubles, okay, that's prime time selling mode, and then maybe you sell it until vol comes back down. It actually looked like after March, the vol never really came back down to earth. It almost seems like the new baseline is 85-ish, and then it finally came back to the 70s, as low as 70, but it actually never came back down to the 50s and 60s. Well, actually, there's a 70 here. So boom, it barely touched baseline again in September. And then, of course, we got another rocket in November. So maybe if you used this chart and you said, okay, I'm only going to sell implied vol when it's 1.5 or 2x over its, recent baseline, that would probably do it, because you're number one, you're going to be catching the pump. So you're going to catch most of the rally, or at least, 25, 50% of the rally, and then sell covered calls when implied vol is high, and going out, 45 days ish probably allows implied vol to contract. So you would make money from one or both of the following: either the price going down, so your covered call contract would be able to be bought for cheaper, or even if the price stays the same, the implied vol contracting, and you would be able to buy the call back for cheaper than you sold it. So selling it selling in covered calls mechanically with no thought process, probably a loser. And that goes for any delta. I think, one standard deviation is around the 0.16 delta, and I know some people just religiously, they'll sell the point 0.1, or they like the point 0.2, or they like the point 0.3. I don't really think it matters which delta you choose, because let's even just grab the super safest one. When the price was 70, if you sell the point 0.1 delta, that's still not gonna cover 70 to 170. That's more than a 2x move. No, that's like, if you go from here from 50, that's like a 3x move. So selling the point 0.1 delta, number one, isn't gonna capture the maximum upside. Now, once you get to here, if you wait till expiration and then roll again, I don't know. I don't know if you'd be able to roll at point 0.1 from here for a credit. You might have to roll up to point 0.2 or point 0.3, which is fine. But if you want to say that starting at point 0.1 at least allows you to roll down to point 0.2 or point 0.3 or point 0.4 or point 0.5, even at the money, in order to capitalize and try to roll for a credit, I guess that makes sense. But in general, I think the point 0.1s are priced fairly. The point 0.2s are priced fairly. The point 0.3 deltas are fair. So I don't think there's much of an advantage there, really. Um, but yeah, if you're a little bit strategic about it, if you're watching this chart, I suspect, you know, but what this would probably do would probably ensure that you would beat buy and hold, because you're only going to scalp a little bit at like the super, super maximum opportunity level. But if your goal is just to barely improve buy and hold, then you'll probably meet that goal. But then within covered call strategies, there's also a competition of, you know, what is the optimal covered call strategy? And I don't know, and I'm not sure anybody knows, but I think this is probably the least aggressive method that would give you like a little bit of, you know, little bit of icing on top of the cake. So if you're happy with just outperforming buy and hold by a little small margin, selling covered calls when implied vol doubles would probably work out. Um, then there's also whether you actually have to make a living. Like I quit my job to do this. So I have to sell covered calls. I can't just not sell covered calls between March and frickin' November unless I want to literally just sell shares. So if you still have your job and you can just, gut it out through 6 months of chop before you get to these peaks and all you want to do is, scalp a little bit. Sure, I think this would be better than buy and hodl, but is that the most effective covered call strategy? Well, the least effective covered call strategy would probably just be mechanically selling them, week after week or month after month at the same delta, not paying attention to IV vol, not paying attention to the price, and then not doing anything with the premium. So if you're not reinvesting the premium into more shares or more long calls, I think that's probably the least effective covered call strategy. And then optimal is going to be in between between those two extremes. So the one extreme of I'm only going to sell when implied vol is like 2x, 3x from its baseline. That'll get you a little bit of an improvement. And then just mechanically plowing into every implied vol and every price is probably the worst method and not at reinvesting any of the premiums. But I think the middle ground would be okay, whether I'm going to sell weeklies or whether I'm, at the money or whether I'm going to sell 30 days or 45 days, whether I'm going to sell point 0.1, point 0.2, point 0.3, as long as you don't need to take any of that money out of the system and you can reinvest it all, I think if you take any of those strategies, and I guess this is where I got to say not financial advice, but this is what I have been doing. Well, since I got wrecked in March, up until March, I was just taking the premiums and buying shares, but that really wasn't enough to cover this insane rally that we saw in March. We got like a 4x in 5 weeks or something silly. So um, I think that taking all of the premium, no matter how much you've collected, and just slamming that into long call positions, well, as money as you can afford, that's probably optimal as long as we're in a bull market. If you continue to do that into a bear market, you will absolutely get decimated because all of the long call premiums that you buy will just go to zero. So it'll be like they just become worthless. If MSTR goes into a bear market in 2026 and you continue buying long calls and dollar cost averaging into, you know, a 50% drawdown over a year and a half period, that is like absolute financial destruction. So in 2025, if it's a bull market, then slamming all of those premiums into long calls is probably optimal. Um, and you're not going to be slamming those premiums into long calls at the tops because you're going to have used those long calls. You're going to have to sell those long calls at the top in order to just not let your shares get called away. So at the tops, you're actually selling off those long calls that you stacked during the down weeks, and that's exactly what happened this most recent week. So I started selling covered calls at like 3:15, something like that. So last Friday, the 315s got destroyed. Then Monday, we opened up higher. So then I think I opened some 325s. Those got destroyed. Then I opened like some 345s or 350s, or doesn't even really matter. Those got destroyed. Then Thursday, I think I sold some 370s. Those got wrecked. So there wasn't a single covered call, even though I was only selling them on green days. There wasn't a single covered call I sold last week that I think actually made me any money. And to close them all on Friday cost me about 50 grand. Now you could say, well, wait a minute, covered calls was definitely suboptimal, except that, and they're not here anymore because I sold them all. But I had been stacking long calls for most of 2024. And I ended up with like 20 of like the 530 strike Aprils or something like that. And I had a bunch of Junes. And I was able to actually sell all of the Aprils for $100,000. So I paid 50 on, on all of the covered calls that got wrecked, but I actually made twice as that much on all of the long calls that I stacked. So that actually worked out. I think I was able to prevent the suboptimal trade that I kind of ran into last March, where this was pre-split numbers, so I only had 300 shares. Price was like 1,200. I sold them for 1,400 strikes a week later, like 15, 20% out of the money. Price went to 1,700. I ended up having to pay like 30 grand to roll. I let 100 shares get called away, and that was a pretty suboptimal outcome. So I think since then I have prevented that from happening. So if 2025 is as good or better than 2024, I'm thinking that's the way to go. And I'm going to go over the positions that I have, but you'll notice this looks a little bit different. Someone in the comments had mentioned that Tasty Trade allows me to group these. So I'll just give a little tutorial on this one. I went to Group By, Custom, and then once you get here, you just highlight the positions that you want to be in a group. And so let me do these. Then you go to Actions, Group Positions, and I'm going to put Covered Calls. I saved this one so I could show it on the video. I didn't really feel the need to make a category for shares. I guess when I add some Tesla positions in here, maybe I'll put Tesla and MicroStrategy both in the shares category. But one of the things that I had noticed as I kept adding and adding and adding and adding and adding freaking different positions, different strikes, different expiration dates, and then every time I would do a video, I'd be like, okay, what am I looking at? And then I'd have to my eyes would go cross-eyed trying to figure out what the hell was what. Like I would look here and I'd be like, oh, okay, I sold 10 covered calls. And then I'm like, wait a minute, the strikes are 900 strikes at 151 days. Like, okay, that's not a covered call. That's part of this call debit spread. So I really like this. I wish I could remember who put that in the comments that Tasty Trade actually does this, but brings up another good point of I had talked before about how I basically 3x, 4x my account by making free videos. Like I don't make a dime from YouTube. I don't make a dime from X. And it's actually funny. It's not a copyright strike, but it's whatever the warning is. It's basically make sure that none of my videos can get monetized every time I do a a music intro. And it's funny because the only countries that my videos are banned from is like Russia and Belarus, which I thought was interesting. For some reason, if I have a copyright strike because I played Missy Elliott's video or music, my videos can't be shown in Russia. So sorry about your luck, Russia. But making these videos has been so beneficial to me just from all of the tips and stuff that people will put in the comments. Like this, and I think Sid Suri put some tax tips in there about if you actually have 100 shares get called away and those 100 shares were long-term cap gains, like you've had them for a year, then the premiums of the covered calls that you collected supposedly also get taxed at long term, and that's pretty cool. That's probably fairly rare unless you're just very strict about keeping your shares for 100 or your shares for 365 days. But it's just little cool stuff like um, that I've benefited from doing these. So yeah, I'm giving away the information for free, but I'm also getting information back for free. So it's definitely benefited me. But that brings me kind of to my second point, which is my exit strategy. And maybe I'll check the comments first before I get into all of that. Should probably be talking about the fucking meme coins too, which is kind of pathetic and ridiculous. But there's only so much I can talk about in one fucking day. What's up, Russ? What's up, K4? What's up, Howard? Rob says, I can't decide if I'm sad or relieved markets are closed during the BTC volatility. Yeah, I was joking that I got liquidated in the January 19th Bitcoin crash. I was, you know, I don't look that much. And so when people were posting, oh shit, it's up to 105 or 106, I can't remember how high it got. And I was like, oh, that's cool. And then I saw people posting, uh, it was like less than a day later, and they're like, "Oh man, isn't it awesome? I'm getting sub 100K Bitcoin again." And I'm like, "What the fuck?" Like we were just going up. What's happening? So maybe Trump coin tanked the Bitcoin market. All the diamond hands sold off all their Bitcoin to buy fucking Trump and Melania coins. Pikachu. So I'm seeing you comment from YouTube. Are you BTC Pikachu? Let's see, you said, which website source do you use to look at vol? Do you look at IV rank? Is that what you use to decide the timing and strike? And then says, do you go by premium amount target? Would you go 8 to 9 weeks instead of 45 days so that you can hit the goal premium? Good question. So I go by Tasty Trades research, and a lot of the research that they've done is just, you know, probably 3 years of back testing the SPY or something. So it's not necessarily 100% translatable and transferable, I mean, to MSTR. But I mean, it probably is. So their research says that if you want to sell an out of the money option, the maximum theta acceleration curve is at 45 days to expiration. So anywhere between 35 and 52 is probably in the sweet spot. You can only get exactly 45 days on Tuesdays. That's when you're 3 days away from Friday. So the 6 times 7 would be 42 plus those extra 3 days gets you to 45. Now, a lot of times you can't get there if the monthlies are not available. So all the W's are weeklies. And this February 21st is a monthly, March, April. There's no May. See how they skipped May? I don't know what the exact deal is with that, but at some point they will add May in here. I'm guessing. But if you're trying to roll out to May and it's not here yet, or if you're trying to roll out to the first week of March and it's not here yet, whoops. Like you can see here, you couldn't roll out to 45 days, well, 39 plus 7, 46 if you wanted to. And so this first week in March, if we wake up tomorrow and it's here, then you could roll out to 45 days. But the point is you don't have to just be like, "Oh my god, it has to be 45. It's 45 or nothing." Like, no, you know, 35, 52, anywhere in there is probably reasonable. And they claim, according to their research, Theta Theta starts at well, Theta is always accelerating. So think about it like this. If you're driving in your car and you're going the exact speed limit, your velocity is 55 miles an hour, but your acceleration is 0. You're not accelerating, you're not decelerating. If you and somebody else are going side by side at 55 and you step on the gas and you start accelerating to 65 and the other person steps on the gas twice as hard and starts accelerating twice as fast as you to get to 65, he's going to get there faster. And then if he lets off the gas and hovers at 65 and you do the same, he just gets there first. And so that's kind of what's happening here. So if you buy the January 2027's acceleration, Theta's acceleration is as slow as it's probably ever going to be. And then it just creeps up and it creeps up and it creeps up. And that's why buying leaps is so advantageous, because there's very little amount of your option contract decaying. But when you get here to 90, it starts creeping up a little bit. And a lot of people start selling their covered calls at 90 days. According to Taster Trade, it's not optimal, but selling at 90 is it's a hell of a lot better than selling at 725. Let's put it that way. I can't imagine having to wait 2 years to realize the profits on selling a covered call. There could be reasons to do it, but I would say 99% of the time it's suboptimal. Okay, 90 days to expiration. Theta increases a little bit. 60, it increases, and then 45, it's got its maximum acceleration, and that lasts, according to Tasty Trade. Again, I didn't do this research, I haven't back tested it, but the research seems pretty solid. So that's my base assumption, is that they are correct. I could be incorrect that they're correct, but I have to start with some kind of assumption. Otherwise, I'm just sitting cash and do nothing. Lasts for 2 to 3 weeks. So you would probably roll, 3 weeks, like 24 days at the latest. As long as everything works out, you would probably roll every 2 to 3 weeks or so, out to 45-ish days again. And I caught a little bit of a nugget the last time I heard Tom getting interviewed on a particular channel. And if I can find it, I think I emailed it to myself. I'll link it in the comments, but he said that actually it's not that theta acceleration stops accelerating at that amount after it gets down to like 21, 25 days to expiration, but it's the maximum theta acceleration before gamma also starts to accelerate. So there's that little tiny window where theta is accelerating maximally, but gamma risk hasn't really kicked in. And then, as we get closer and closer to expiration, gamma risk, which is, how much the wild fluctuations in delta can happen on price moves, that really starts to amp up under like 21 to 25 days to expiration. So theta is, still just keeps careening under 25 days to expiration. It's not like it's accelerating like crazy and then somebody just slams on the brakes. But there's this little sweet spot between 45 and 25, 21 to 25, where theta is accelerating, but you still don't have that short-term gamma risk. But then under 3 weeks, gamma really starts to kick in. Gamma risk doesn't really bother me as much because I sell covered calls. So in a sense, I don't have the same kind of gamma risk that the Tasty Trade folks have because those fuckers sell naked. They sell naked calls. Like I think he said I think he said like 75% of his positions are naked shorts. Like he just sells 75% of his most common trades are strangles. And he's got a short put and a short call on positions, and he's just trading the vol. He doesn't give two shits where the price goes. And then maybe like 25% of his positions, I think, were more like defined risk trades. And that blew my mind. I had probably heard that statistic, something along those lines before, and I knew that they were just not afraid of selling these unlimited risk trades. And he can do that because number one, he's filthy rich, but number two, it's all about position size. So if the guy's worth, I don't even know. It doesn't even matter. Is he worth 10 million? Is he worth 100 million or somewhere in between? I don't know. The guy's got a shitload of money. He's only going to risk like, I don't know, 1% or less, probably less than 1% of his entire portfolio in a short position. And even if he loses 10x, like that's 10% of his net worth. So it's not like these 100x levered on margin degen trades. You know what I mean? He's um, it's only theoretically unlimited losses. But anyway, I just never do it. So because I don't do it, gamma risk is less meaningful to me. I really don't give a shit because the worst, even if my covered calls are getting completely wrecked at expiration, there's no extrinsic value left anyway. So the worst thing that can ever happen is my shares get called away. If you want to say that's picking up pennies in front of a steamroller, that's fine. I tend to disagree. I think that the naked call selling is the only real steamroller that exists in options, which is why I don't do it. But anyway, that was a long ass way of explaining that when I'm choosing my strikes and my days to expiration, if I do want to sell out of the money because I want to capture some upside, I will probably be drawn more to the 45 days to expiration. And when I'm just trying to generate cash, I'm going to do it no matter where IV rank is. As long as the premiums are decent, I'm just doing it. Now, when I want to add positions because IV is up to 50 or 60 or 70 or 100 or whatever, then I'll add extra positions if I need to, or if I think it's beneficial. If premiums are going up, okay, yeah, I want to add positions. If I don't want to sell out of the money because I really don't care about the upside for whatever reason, then I'll sell the weeklies. I'll sell the 7 days to expiration. And since I don't need to worry about the theta acceleration curve so much, it's really just optimal at the money. So that's why I added the weekly covered calls that I put on Friday were at the money basically. The price was like 396, 398, something like that. So I just sold some at the monies. Now I also put on some out of the monies. So I'm showcasing both of the strategies here. I went out to approximately 45 days to expiration. I sold these almost 50% out of the money. Yeah, 600 strikes would have been 50% out of the money. But the weeklies I just sold at the money. And I collected the same damn premiums for each one. Now, if the price hovers over the next 6 weeks at 400, then I would make 2,000 a week 6 times. So 12 grand, which is cool per contract. Um, and then if we're still at 400 in 6 weeks, I would probably be able to buy these back and sell them again and roll them for 2 grand. So in 6 weeks, let's say I get to do it best case scenario, I roll it every 2 weeks, so that would be 3 times. So I'd probably be able to get uh let's see, I'd sell it for 6 grand, but I'd have to buy it back for 3 times. So I'd really only get about 3 grand over 6 weeks, whereas selling the at the monies, I can get 12 grand in 6 weeks. That's great if the price stays at 400, but if the price goes to 600, then I've collected this 12 grand guaranteed profits, but I missed out on $180 per share. So what is that? 18 grand? Yeah. $18,000 per contract if the price rips. So it's all about trade-offs. The weekly one is not better because you get more premium, and the 45 days out of the money one isn't better because there's more callaway value. It's just whichever one you pick, you can't get the benefits of the other one. Let me just check and make sure I answered half of your question. So, yes, I look at volatility. Do I look at IV rank? Yes. I like Tasty Trade's metric. And is that what you use to decide the timing and strike? Not really. Um, a lot of people like 45 to 60 days to expiration because it gives you enough time to be right, and you can kind of make sure that you give the market time to come back down and find support again. But because I have my account protected with so many of these long calls, I'm not really worried about it, right? If 20 of these covered calls I have to end up covering, if I have to, I can just sell 20 of these Decembers for 12 grand a piece. So what is that? $240,000. So, my covered calls can get wrecked by quite a bit before I would just end up not having enough long call positions to pay to prevent my shares from getting called away. And then you said, would you go 8 to 9 weeks? No, I would not, because I'm following Taster Trade's recommendation of 45 days-ish. All right, Rahat says, for long calls, what criteria are you considering to know what's a good buy? You're on X, so my pinned comment or my pinned post is my options mega thread, and you'll probably want to look at the video how I buy calls from an option seller's perspective. But I'll go over it. So I've already listed why Tasty Trades research says that selling options under 60 days is optimal. But if I reverse that and I say, okay, well, if I'm not a seller and I'm a buyer, but the sellers are sensing blood in the water under 60 days, under 90 days, then why would I buy options that are a seller's dream? You can make money with those long calls. If you're a momentum trader or a day trader, you're scalping. If you know how to do it and you can be profitable with it, great. Keep doing it. I don't, so I I don't do make those trades for the most part. I fucked around with a couple of 0 DTE trades, and I think out of the 3 that I tried, I won 1 and lost 2. So my batting average isn't great with those trades, but It was fun to screw around with on a very small position. But yeah, I basically just take everything that's good about selling options under 90 days and reverse it. Um, but let's just analyze the different long calls that I own. Why do I own June 1080s, but I own actually the poor man's covered call has the other strategy. So why do I own some Decembers that are in the money, the 200 strikes, and I also have some Decembers that are out of the money, and they were way out of the money 81 days ago. They were these 530s were the highest strike available. So 1080s are the new 530s, right? As MSTR pumped, they had to just keep giving us higher and higher and higher strikes so that we could actually have some out of the monies to purchase. So as an option buyer, and really you should ask the same question for your every time you purchase or sell anything. What is my goal? What do I want this option to do for me? In the example of the 200 strikes, I bought in the money calls because I wanted to be able to sell calls against them. You have to have at least above 0.7 delta is probably reasonable. Some people prefer 0.8 or even 0.9. The higher you go, the more expensive they're going to be. But it can be a cost-effective way to do covered calls. It's called a poor man's covered call because you need less money to do it than actually buying 100 shares. So if my goal is to form a poor man's covered call, then I have to buy an in the money call. If my goal is just to sit on my hands and do nothing and hope the price goes up because I'm bullish, then I'll just buy the farthest out of the money one that I can get, because the amount of delta that I can purchase per dollar is the greatest. It's also, theta is going to be a little bit higher, so the money is going to be draining out of those options a little bit more. So again, the 1080s are not better than the 980s, and the 980s are not necessarily better than the 880s. But for me personally, if I want the most delta, the most price action that I can get, then I'm buying the most farthest out of the money ones that I can buy. But an option that I purchase, if the price goes in my favor, it can actually become a different type of strategy. So once we get to like 600 a share, I'll be selling covered calls against every single one of these damn positions right here. When the price was like 250 and I bought the 530s, they weren't fit to sell covered calls against. Delta's at like 0.59 right now. So once it gets up to 0.7-ish, I could do this as a ratio spread. I could probably sell covered calls against 10 out of the 20 positions. The Januaries have the same goal for me that the Decembers did. It's just in a different tax year. So if I have to, I'll make a decision on these Januaries, at the latest, maybe the beginning of 2026, because I'm assuming that the bull market will be over. So I don't want to hold these too far into 2026 and lose value. I've already lost half my money on on the Januaries because I bought them in like November ish, 60 days ago, right? So Yeah, November 20th-ish. But for the most part, I'm not buying calls under 90 days. I think the seller's that's to the seller's advantage. And then as long as I'm buying beyond 90 days, closer to 180, or in the case of poor man's covered calls, probably 360-ish days to expiration. And then for poor man's covered calls, they're going to have to be in the money. But if it's just speculation, it can be any strike you want. But for me personally, I want the cheapest I can get. And then like these Junes, I just rolled didn't I have April's? May, June, July. I thought I rolled some out. Yeah, here we go. Yeah, so this is the other strategy. These are my other long calls. I put this category roll every 90 days. So I rolled my Marches, my Aprils out to July, just to make sure that I don't go under 90 days to expiration here. And then in April, when these are about 90 days to expiration and Theta is about to start accelerating even more, I will roll them out to August, September, October. If it's for a credit, great. I'll take some profits. If it's a loser, then I'll just, roll them out to October for how much ever I can get. Or, if we get some kind of blow off top by July, and MicroStrategy's like 2,000 a share or something stupid, maybe I just take them off completely and I'm like, nah, I don't need to roll these out. I don't need to roll these out at staggering all-time highs. They've served their purpose at that point. What's up, Howard? Howard says, if you put all your premiums into long calls when you get them, presumably at high vol, won't you be paying more for the vol than if you put them into shares and waited for a pullback in price? Yeah, that's a good point. And I hope I didn't say that the wrong way. So when I'm saying I'm going to buy long calls, I'm talking about during all of this chop here. So implied vol was actually low. When the price is spiking and implied vol is spiking, I am not buying long calls here. I am selling the long calls that I stacked, and I'm opening new covered calls positions here. And because the covered calls that I sold here are probably getting wrecked, I'm using the new covered calls that I'm opening, and I'm selling long call positions to pay for those rolls. So here, if I'm selling, if I'm just selling a bunch of covered calls and I'm buying them back for jack shit, and I'm selling covered calls and I'm buying them back for jack shit at low implied vol, this is when I'm stacking long calls. And to your point, if I somehow manage to sell covered calls at the top and I have money and I don't just want to let it sit in cash, I would absolutely buy shares. I would rather buy shares at all-time highs than buy long calls at all-time highs. So that is absolutely correct. Yeah, and Pikachu's basically saying the same thing. That's what I was thinking too. I would rather buy shares and sell calls till down to last 100 than buy expensive calls during than buying expensive calls during high vol. Yeah, that's it exactly. All right, I'm just reading through these comments. Okay, so Atilio says, what does it mean to buy it back and roll it? So rolling is kind of a shortcut for closing a position and reopening it. If you bought it to open it, you have to sell it to close. If you sold it to open it, you have to buy it to close. Everything in options is always backwards. So let's just look at my covered call position. I sold the 500 call, the 500 strike for 221. Sometime before 221, I have to manage this position. I could either just buy to close, this little tab here, or I could roll this position, which this is just kind of a shortcut that Robinhood puts in here for you. It allows you to do both steps with one click. So if I wanted to roll this out to the next expiration date and I wanted to do it in 2 steps, I'd have to buy to close, and then I'd have to go to view all options, select my expiration date, select my strike, and then do another sell to open. That's closing your position and then reopening it. That's called a roll. Or you can just do roll this position, and it's automatically going to attempt to close my $500 or 500 strike. And then, do I want to roll it out to the 28th? Okay, what strike do I want? Do I want the 490? Do I want the 520? This would be rolling out a week and up to the 520 if I was to do this. Thanks for the question. Rob says, I like those January 26 1080s. Super Vega sensitive. They doubled on IV alone, sell half, ride the rest. Yeah, that's a good point. And that's kind of why I did a video on this. I don't know if it was last week, but Vega is kind of the key to why I don't mind losing my upside, even on these weekly at the money covered calls, which are like insane. Like, as bullish as I am about MicroStrategy, like, I guess my base case is probably like $1,000 a share in 2025. Like, if it doesn't get to 1,000, I'll be almost kind of feel like I'd have to apologize for being so bullish. um, but yeah, so when I sell a covered call, even these at the monies, right? I sold the 400s. Vegas 0.16. And, like Rob mentioned, the ones that are going to be like way out of the money and longer duration, Vega is going to affect those options. But on Friday, January 24th, Vega doesn't matter anymore. At 3:59 p.m., Vega is meaningless, because if this option goes in the money and the price is 425, the only thing that defines this option's price is the distance between the strike and the underlying price. At 3:59 p.m. on January 24th, if the price is 425, the value of this option will be exactly $25. Delta will be pegged at 1, or maybe it'll be 0.9999, but it'll basically, anything below 1 will basically be a rounding error. And gamma will be 0, because delta ain't changing anymore. Once it's pegged to 1, it's as high as it can go. So gamma doesn't mean shit, and Vega doesn't mean shit anymore. And theta is also at 0. So the point is, even when the person who buys the covered call that I sold, even when he wins, he can't benefit from Vega. The only thing he can benefit from is the distance from the price to the strike. He's basically has synthetic stock at that point. Golf clap for him. He won. That's great. But when I take this 2 grand and I start stacking a shitload of these long calls, June, July, December, January for next year, these are all going to be massively affected by Vega. So this giant implied vol spike are going to make my long calls immensely valuable. But the guy whose option is about to expire cannot benefit from Vega. So I don't know how much more beneficial that is to me, but it kind of just took a little bit of that anxiety off of my soul. Like, oh man, I sold these, I sold the 315 strikes last week and I had to pay $8,500 to close them out. But to a certain extent, it didn't matter because my April 1080s, or actually, I'm sorry, my April 530s, you know, implied vol, Vega, pumped the value of those options in a way that these in the money calls that were expiring could not benefit from. So it worked out. How do I get rid of this comment? Okay, hide. Big Dave says he's got some Riot folks, but I didn't say any Mara. So I stopped selling. I used to love Mara, and when I say I loved them, the only thing that I care about with the miners is liquidity. I want a tight bid ask spread. So that's why I've only very occasionally sold options in Iron. Iron might be the best mining stock. I don't know. I don't read their 10Ks. I don't listen to their earnings calls. I don't do research on who has the most tera mega hashes or is using AI and has battery storage and is building shit in fucking waterfalls in Africa. I don't know, and I don't care. I care about my MicroStrategy positions, but with the miners, all I care about is. And I thought my Riot shares were going to get called away. Why didn't my Riot shares get called away? What did I sell? Yeah, I had the 13 strikes. So these should all gotten called away on Friday, unless I only sold one. I might have forgot to put 7 instead of 1. Whatever. Okay. So trade Riot options. This is what I care about. I want to sell a call. I want to get a fill. The bid ask spread is nice and tight. It's 5 cents wide. That's fine. I would prefer it to be a penny. Like if you're trading the SPY, you can get a penny. Here, this one's decent. That's a penny. 29, 30. That's a perfect bid ask spread. I can get into this trade. If I want to get out of this trade, doesn't matter if it's for profit or for a loss, I can get out. I'm only going to pay $1 to get in. I'm only going to pay $1 to get out. That's what I want to see. So I used to trade Mara. I used to trade Riot. I used to trade Hut. I used to trade, CLSK, and less so Iron just because of the liquidity. There's our increments of nickels. So if I have to pay $3 or $4 to get into a trade and $3 or $4 to get out of a trade, and my profit is only $20, like that's like a third of my profits just leaking through the bid ask spread. The other parts of liquidity is like volume and open interest. So seeing a bunch of it is great, but the main thing is the bid ask spread. So I stopped selling Mara though when, I wasn't like looking for the research, but scrolling on X long enough and I saw that they were mining like Caspa and I was like, no, fuck them. So if you're not a Bitcoin only miner, then I probably want to have nothing to do with you. So I just assumed that their management team was garbage and I swore off Mara at that point. Hut, I don't know why I stopped selling them in Hut. It probably just took off and it was less cost efficient. So like Hut was like $10 a share, the same as Riot and CLSK, and it just went nuts. So I'm pretty sure somewhere along the way my shares got called away and I just forgot to go back in like when they crashed from 30 to 20. Like maybe I should have sold some puts here and got back into it. But I think Riot and CLSK were just cheaper. So I was kind of dollar cost averaging into those instead of Hut. But for right now, I would absolutely trade CLSK, Mara, and Hut without batting an eyelash. But uh, Mara can eat a bag of dicks, and Iron is probably a fantastic company. If I was just going to buy shares of it or just buy long calls for end of 2025, I would probably just grab some. Um, just to diversify and like, okay, if I'm gonna hit a lottery ticket on one of the miners, maybe I'll just take a little lottery ticket in each one of them, see which one does better than the others. But yeah, I really don't have time to be digging into all of that shit. It's not interesting to me. Adrian probably knows a lot about that stuff. Maybe Ben. Uh, they're probably smart enough and interested enough to be able to comment on who's got the most hash power and uh, the best management teams or debt structures and all that shit. I think some of the miners are actually selling convertible bonds. So that would probably be a leg up. Like anybody who's doing the Sailor playbook, I would probably give a nod to any of those companies. So if anybody knows like, oh yeah, this company's doing convertible bonds, okay, they're probably the best mining company. I don't know. I wouldn't do any more research beyond that, but that's just me. I just don't have time for that shit. But yeah, I had some CLSK and like I don't know how many hundreds of my shares got called away because I think I was selling the 13s or the 11s or something. Let me see if my assignment event is in here. Yeah, I sold the 11s. So those got called away for sure. Oh, but this Riot position. So a friend of mine and his girl, they wanted to just kind of do a lottery ticket and they're like, "Hey, let's buy like a January 2026 out of the money call." So we went and bought like the 22 strike. So it's just sitting here. If Riot rockets up to $20 a share or something, these will do well and maybe we'll sell them for profit or something. But this was just for fun. We decided to copy trade uh, that one. Pikachu says he's gonna let me explain. Yeah, that's exactly right. 2 to 3x is kind of like, eh. Um, yeah, with those long call positions, the Aprils that I just sold, if I had sold them in November, I probably could have sold them for twice as much. I think I got like 5x on the Aprils, and I could have gotten 10. But man, FOMO is real. Like in November when it hit 500, it's like, man, it could go to 1,000, right? So I definitely did not capitalize as much as I would have liked. Like these Decembers, they're a little bit 2.5x, 2.2x, something like that. But I these 530s by December, I expect to at least be 10x. And then the whole time, once these go to like 600 a share, I'll just be selling covered calls against them. So not only will these probably go up 10x from what I bought them for, but I'll be making covered call premium against them for as long as the bull market holds in 2025. So, um, and it's wild because before I saw Quant Bros 1, I never really even traded directionally. So my base assumption when I started this is that the stock market basically goes up like, is it 3% over 100 years? Like on average, it just, there's like 53 positive trading days and like 47, red trading days a year. And so over time, it's just kind of up and to the right. Um, so I was never more directional other than just kind of like mildly optimistic that number go up more than number go down. And all I cared about was collecting premiums. Covered call strategy is a limited bullish strategy. And I figured, okay, if the market is limited bullish and I'm not a genius and I don't know how to pick out AT&T in 1960 or whatever, then the best way for me to increase my chances of success would be to reduce my cost basis by selling cash secured puts, selling covered calls. Every time I do that, I give myself a greater chance of success by giving me a decreased chance for failure. That's kind of the whole point. Um, and you can do that on any stock and not have the slightest idea about it. I mean, a lot of analysts don't do better than a coin flip anyway, and they get paid for this shit. So that was kind of how I mentally aligned myself with the covered call strategy and the wheel strategy. But once I got orange pilled and I was like, holy shit, there's this derivative built on the best asset, the best money in human history, I was like, oh, maybe I should be a little bit more bullish about this. And so I modified my straight covered call strategy to wanting as much leverage as I could get my hands on. Um, Probably ended up with a little bit too much leverage. And so that's why I'm more than happy to unwind some of it. Like, um, I took $100,000 worth of leverage off of my account last week, right? I closed $100,000 worth of long call positions and I only opened up like 30 grand in July, right? Yeah, 10 positions for 36. So I spent like 36 grand. And then I opened some new covered call positions. So I reduced my long exposure there as well. I'm totally fine with that because I'm probably over leveraged. I'm happy that I got rid of my margin use, so I can't be liquidated. But still, if MSTR goes to zero, then I'm fucked, and I'm dusting off my resume. Rob says, agreed. I like selling the weekly covered calls at Gamma Max. Always impressed you so well with the 45 DTE. Oh, impressed you do so well with them. Yeah. Yeah, I kind of I can't decide. I can't decide right now if I like weeklies or 45 days. So I'm basically making a decision by not making a decision. I'm just doing them both. I did 5 of the at the money weeklies and I did 5 of the almost 50% out of the money 42 days. All right, you guys are chatting back and forth. And then Professor 808 says he has options on Tasty Trade and Robinhood, or are they connected? No, I'm trading in two accounts. I have a little bit of loyalty left over from Robinhood because um back when I started in May of 2020, I think I started with like 5,000, and then when I was like, holy shit, is this I felt like I was just printing money, and I was like, oh, this is easy. And I know this says negative $30,000, but that's because I've actually removed more money from this account than I put into it, which means it's technically overall in profit. Um, but at one point, it was down big. I was down big after being up big. That's the thing. But back when I had a small account, I was trading on Robinhood for free. So let's just say I sold, you know, a Riot covered call for 20 bucks. If I had paid E-Trade 8.95, because some of you might not be old enough to remember that when you were able to trade E-Trade at the beginning, I mean, it was fucking expensive, and it was per trade. So imagine I sold a 15 strike covered call for next week for $30, and I got to pay 8.95 to E-Trade. It was groundbreaking when Robinhood said, "Nah, you can just trade for free. We don't give a shit." And on a small account, being able to keep all of the money was insane. So I definitely appreciate Robinhood for that. So I've continued to trade with them all along. I was a little bit bitter during the GameStop trade when they turned off the buy button, but I don't think they're the only ones that kind of bent over and took it uh, from the hedge funds or whoever was making that phone call. But they definitely betrayed themselves. So I made almost everything that I know, I learned from a Tasty Trade video or else this other guy's channel, In the Money, on YouTube. Also, Kamikaze Cash's channel's pretty good as well. There's a bunch of other good channels that I've found since then, but those were the ones that helped me at the beginning. And so I was like, you know what? Tasty Trade's got all these cool tools, and they're options traders at heart. So they built this platform around options trading. However, it's not free. So I think I pay $1 per contract. Um, which also doesn't hurt me as badly when I'm selling a covered call for $2,000 and one of those dollars goes to Tasty Trade, like, okay, big whoop. I think if you sell a lot, like if you sell 20 of them, I think you only pay 10 bucks or something. Um, but this, I almost kind of feel like I'm tipping the waiter. um, Tasty Trade has benefited me so much that, and I like the tools. I initially actually opened my Tasty Trader account just for the tools, and I didn't trade here. I just used the tools to help me trade in Robinhood. Um, but at one point, I just moved all of my money over to Tasty Trade for the most part. And then, was it March of last year? I was like, oh, you know what? Let me do a 5K challenge. So, it's one thing to say, all right, if you can afford, 100 shares of an expensive stock like MicroStrategy, it's one thing to be able to say, okay, sell this covered call and make $2,000. Like, oh yeah, that's easy mode. But I was like, all right, let me just put 5K in this account and see what I can do. See if I can make money with the mining stocks. And so that's why I went ahead and put 5 grand in March um, into Robinhood, and it's done pretty well. I thought I was gonna. My goal was to turn it into a day trade account, which in order to be a day trader, you have to be able to get it up to 25 grand. I thought I could probably do this in like 4 years, um, even if the prices went nowhere. But of course, the prices did go up, so uh, it didn't take 4 years. Jacksu says, "Have you considered a position in MSTY? I learned that due to return on capital, around half of the dividends are not taxed and go into reducing the cost basis of the shares." Okay, I'm not aware of that. That would be interesting. The rumors that I had heard was that that dividends has some of the worst tax treatment available, but since Misty's not a true dividend stock, maybe they get away with something. You said the return on capital, around half the dividends are not taxed and go into reducing the cost basis of the shares. Um, if you can expound on that, maybe explain it to me a little bit more. I find that very interesting if that's the case. Um, I did a video on MSTY and I was a little bit down on them just because you have to pay a management fee. And my basic assumption is if they're selling options and I'm selling options, but if I have to pay them 1% to do it, I should be able to outperform them. I may do a side by side kind of challenge and see if I can beat them with an equal amount of MSTY and just do it like a drip and just reinvest the dividends in an IRA account. And then I'll trade the same dollars in a cash account and see if I can outperform. But I didn't give them as much of their due as I should have because from like, wherever MicroStrategy was here, MSTY went up like 2x, but MicroStrategy went up 3x. And I was like, oh, see, MSTY is underperforming. But I didn't take into the calculations that if you reinvested the 10% profits, that actually makes the difference, and MSTY would have actually performed pretty much just as well as MSTR just buying spot and holding it. And then I was thinking, well, you know what? If we do go into a bear market, MSTY may actually outperform because all of the covered calls that they're selling will just be pure profit for the next year and a half. So if MSTY is kind of keeping up with MicroStrategy in the bull and doing better than in the bear, that would be insane. That would be, uh, big props to them, but, they've only been open since, February. So, it's gonna be interesting to see how they do in a bear market, but, yeah, it seems reasonable. I just refuse to pay anyone a management fee to do what I can do. They might be able to do it better than me, but it still pisses me off. I don't like it. Bitcoin Hero says, "Are you in the US?" Was that to me or one of the commenters? I'm in the US, yeah. And so the European options, I don't know them exactly, but you don't have to worry about early assignment over there. And I think they just settle in cash. So um, you have a little bit less to worry about than American style options. And then Howard says, if part of the payout of MSTY is return on capital, then that part shouldn't be taxed, but it will decrease your basis and you'll get taxed when you sell the shares at some point that may be at 20% if greater than a year. Hmm. All right, very cool. So yeah, MSTY might be better than I thought. I mean, I thought it was pretty legit, but my decision on that was they'll probably underperform spot buy and hold, but I could absolutely be wrong with that. They might they might outperform. I'm just not sure. All right, so that was a big ass tangent, but I was talking about my exit strategy. And so I resigned my position in December. Um, I'm not like filthy rich, but I know that even if MicroStrategy was to crash 50 to 75% from its current prices and stay there, I could probably squeak by until the next bull market and I'd be fine. I might have to eat Franks and beans or whatever for a couple of years. Um, but like right now, I can pretty much just press a button and decide how much money do I want to make this week. Do I want to sell 5 covered calls and make $10,000 a week? Okay, I'll let the rest be upside. Do I want to sell 10 of them and make $20,000 in cash this week? Maybe I've got some bills to pay or I want to go Christmas shopping. Do I want to sell 30 covered call this week? And is that 60? Yeah. Um, and so that almost kind of leads me to like, well, why wouldn't I just sell 40 covered calls a week and make $800,000 next year? Um, and the reason is because I'm basically expecting MicroStrategy to be, I don't know, $1,000 a share at some point in 2025. Can't imagine that it won't hit that much. Could be completely wrong. Maybe it doesn't go over 425. I don't fucking know. But I'll be selling covered calls the whole way. So if it doesn't, I kind of don't care. Um, but yeah, I'm not selling 40 covered calls a week and taking a guaranteed $800,000 in 2025 because I think I can make more by not doing it. That's how bullish I am on MicroStrategy. It's kind of insane to think about. Um, yeah. So it's kind of like, what do I want to do with the rest of my life? Because it's almost like money doesn't matter. Um, I quit Facebook a couple of years ago and I don't regret it, but it just turned into a kind of a shit show. They were censoring, but I was also wasting a bunch of time. I used to argue about politics. I used to argue about religion. I used to argue about um, whatever anybody wanted to argue about. I was happy to argue. Um, I came across some libertarian slash anarchists, and after listening to them argue back and forth with Democrats and Republicans and socialists and capitalists and all the other ists, I was like, holy shit, these guys are fucking right about everything. So at some point, I realized I was a paranoid crypto anarchist. Um, and that's also, I found, one of those anarchists was also into options trading. So that's how I got put onto that. It's how I got put onto Bitcoin. So I owe my entire well-being and world philosophy to a bunch of nerds like me that I met on Facebook. One of those guys was actually somebody that I reunited with from high school. Um, we'll call him Scuba Steve. And another was a guy named Mike that I met specifically on Facebook. Um, but he's the one that put me onto Bitcoin. So I owe everything, kind of good about my life to a stupid ass social media site. But at some point, it just became scrolling and arguing, and I'm like, nah, fuck this. I'm not gonna waste my life scrolling Facebook. So quit that, but I kept in touch with those guys. So I took the good parts of Facebook with me, I guess. But I'm starting to see X in that same way. Like in 2024, I'm like, you know what? I'm gonna build an X account and maybe I'll get monetized one day and I'll have 10,000 followers and Elon will cut me a check and it'll be an extra income stream and I'll buy Bitcoin with it and just whatever. But now it's kind of like I don't need to build an X account. I don't give a shit if Elon gives me any ad money. Um, That's why I keep that's why I keep almost intentionally getting my copyright strikes on my YouTube when I put the music intros on. I just kinda giggle to myself when they're like, you can't get monetized on this," and I'm like, guess what? I don't give a shit because I don't need your stupid ad money." Um, but at some point, I kinda realized that I was doing a lot of scrolling on X, and, it's a kind of a similar experience because I'm meeting a lot of cool people, I'm learning a lot of good stuff, but at the same time, my addictive personality finds it hard to like, when I wake up in the morning, I check my phone for the time of day, and then, maybe I fire off a couple of text messages and check posts and responses and who posted this and who posted that, and did MicroStrategy buy any Bitcoin this week? And, um it reminds me of, like, when I used to play EverQuest way back in the day, and it was just, like, quests and leveling, and you're just grinding and, trying to power level, lower level characters, and it's just all about just grinding and grinding, and then, I stopped playing that and I moved on to WoW, and that was even better, but more addictive, I mean. And at some point, you're just like, "Okay, how many maxed out characters, can I have?" And I'm just grinding the same daily quests. And, X is a little bit starting to feel like a grind. And now that I can just wake up and do anything that I want. I'm like, "Okay, well, what do I wanna do?" Because for most of my life, it was you wake up and ask yourself, "What do I have to do?" You have to go to your fucking job because that's how you buy groceries for your family. And you got kids, so I have to get them ready. Um, you got a wife, you gotta pat her on the butt once in a while, and, there's a lot of stuff that you have to do, and a lot of that you wanna do, right? I'm not saying taking care of my kids I isn't fun. Yeah, there's lots of cool stuff about life, but it doesn't alter the fact that, my kids are out of school and I quit my job, and now it's like, "Okay, I don't have to do jack shit. So what do I wanna do?" And it's not scroll all fucking day on X. That's for damn sure. Um, I do enjoy these videos, but at some point I'm like, it's just me talking about the same shit every day. I've got the essentials in my pinned post on X. I'm gonna film something with Bitcoin Not Crypto. Uh, I'm gonna be on I'm gonna record with him tomorrow, and I'm gonna take a little bit of inspiration from that. I was already thinking about it, but BTC Pikachu put that poll out there. Will options or will covered calls beat buy and hold? And I'm probably going to record a video around that, but I'm going to talk about it on Bitcoin Not Crypto's channel tomorrow first before I do anything about it. Um, but I'm going to put that video in my options thread, my mega thread. And it's basically, asking what covered calls can do. What are your goals? What do you want to do? And do your goals align with what it's actually can do? So, like, why would you even do it in the first place? Because if it doesn't meet your goals, then just don't do it. So I think I'll add that to the thread, and beyond that, it's like, okay, I can talk about spreads, I suppose, but there's already so many good channels, like In the Money's channel on YouTube. Um, there's so many, like, what was the other one? Is it Project Finance, I think, is a good channel. But there's so many other good channels out there. I'm like, do I really think that I can say the same shit that they said, but better? Like, probably not. Um, so I'm not really sure how much more I can even offer. Sailors, the 10 things that he recommended, like what was number 10? Upgrade the world, right? Like, I'm not sure. I've made 331 of these videos. I'm not sure at this time next year if I'm on episode 662 if I'll really be upgrading the world that much. Um, maybe maybe making videos through the next bear market might be helpful, but after a full cycle, right? Once we get back into the bull market, maybe in 4 years, it's just the same shit all over again. So, um, if this ever stops becoming something that it seems like it's upgrading the world, I'd probably have to quit. So, I've got a couple other ideas in the back of my head, like I want maybe like a carnivore slash Whole Foods restaurant type of thing. Um, maybe like a martial arts studio with an integrated, like, physical therapist informed exercise plan, like trying to keep people from hurting themselves. Oh my god. I wrecked both knees as a white belt in jujitsu last year, and ended up spending, like, 6 months out of class rehabbing, and I've barely even been back. Like, I started taking the boxing classes instead. So I'm like, "You know what? Maybe if there was a martial arts studio that actually could do intelligently designed classes that prevent people from hurting themselves, maybe people wouldn't, sign up and quit 3 months later." I've got that idea. Oh, what's the other one? So I've been following this guy's channel, Beckman Dog Training or something on YouTube. I cannot stop watching his, like, aggressive dog training videos. He's got this, dog named Bosco that passed, but he was an absolute fucking dog whisperer himself. Like, that frickin' Doberman was amazing. He's got this new dog, Prince, who's following in his footsteps and doing really well. But I thought, "You know what? What if I had just, like, a giant ass dog rehab center or something?" Like, I gotta do something with this money that's not just fucking shuffling money around, right? So, those are just some ideas that I've had, like, what will give my life purpose for the next, 50 years. I'm already planning to live to 100, maybe 110, 120 if I'm lucky, especially with science coming out with ways to keep us healthier. So, especially with like AI and robots and shit taking over everybody's jobs. And maybe I'll have a dozen Optimus robots feeding the dogs and cleaning up their shit because I definitely do not want to pick up 100 dogs worth of dog shit and putting 100 dog bowls out every day. But yeah, so my exit strategy isn't necessarily exiting the options market or exiting MicroStrategy itself, but you know, these kind of trading. I mean, I can spend 8 hours a day in here trading, but easy mode, I could probably just get away with a couple a couple hours a week every Friday and just be done with it. And just not even look at the market Monday through Thursday unless I get assigned or something. Then maybe pop in on Monday and sell calls on something that on puts that got assigned. And after that, I don't fucking play golf. Uh, I like fantasy football. Maybe I'll just be a professional gambler, learn how to play poker, or I'll just go sit at the blackjack table or something. I don't know. Um, but yeah, I mean, if X just starts to become an endless scroll fest or a grind, I will. I don't know. I'll have to see my way out of this whole damn thing. Bitcoin Hero says, "I'm in Canada. Have you used Interactive Brokers? Tasty Trades isn't available in Canada." I have not used Interactive Brokers, but plenty of people do, so it's probably all right. Howard says, I'm doing Jeff's idea of moving my HSA to Misty as it isn't taxed at all. Yeah, that's a solid plan. When I do the challenge, so my IRA, you know, this is the blue diamond is my IRA. So I'm just going to move this entire account over to MSTY, and then I'll add, I have to put in a request to Tasty Trade to add another account, and then I'll fund it with an equal amount of money, and I'll just put MSTY in my tax protected account. Jack says the idea that the return on capital will eventually reduce the cost basis of Misty to zero, and any future return on capital earnings will be taxed as long-term cap gains if you hold for over a year. All right, I'm gonna have to read that a couple of times to understand that. I do understand about the reduced cost base. So eventually, it's going to reduce your cost basis to zero, probably after like 6 months. No, 12 months, 10% a year, or 12%, 10% a month. Yeah, so in like a year, your MSTY shares would probably be free. And so then any future return will be taxed. Okay, so they're going to give you credit until your MSTY cost basis is zero, and then you get taxed. All right, that makes sense. Pikachu says, considering nothing burger from Trump today, do you still think MicroStrategy will go to 1,000? What if Bitcoin tops at 120 and everyone is wrong? Hope not. I'm waiting for 4,400. Yeah. Um, yeah, I'm assuming that Bitcoin doubles from here, at least 50% from here. So if Bitcoin goes to 150 or 200, then MSTR goes to 800 to 1,200, maybe 1,500. So that's why I'm thinking that's kind of like my base case. If, like you said, Bitcoin only goes to 120, that would be kind of brutal, but that's still an extra 20%. So MicroStrategy goes to like 500 a share or something. um, that would still be fine, I suppose. Um, if Bitcoin tops 120, like in October, we're still at 120 or less, then I'm just going to assume the bull market is over, right? I'm not assuming it's a super cycle or any of that. It could be a super cycle, but I'm not counting on it. Um, yeah, in that case, we don't get 1,000, and all of my 1080s are garbage, right? If we only go to 800 a share, all of my Junes are garbage, but I won't be holding these until expiration. So that's a little hack for options. They can only expire worthless if you let them expire. So I'm buying these June 1080s, but I'm not saying I think they will be worth 1080 in June. What I'm saying is sometime before, let's see, March, April, May, June. Yeah. Sometime before March, there will be some kind of spike that will allow me to sell these at some profit. So if it only gets to 750 in February, like these will still be very profitable. And I can take some of these profits off the table. Anything that I hold, if I held these to June and we're only at 650, yeah, I'm shit out of luck. I'll still be selling covered calls all the way. But yeah, if we never get to 1,000 a share, it's fine as long as long as it doesn't go back to like 100 a share in 2026. I'll probably be all right. Bitcoin Hero says, where and how did you learn your option strategies? So in the money YouTube channel, Tasty Trade research and videos. Yeah, that's mostly it. uh, some other some stuff here and there, and of course, I've been learning on X ever since as well. I never really messed around with the long calls too much until I saw Quant Bros 1, and I was like, "Oh, shit. I should be way more bullish than I am." Alright, we're all caught up on comments. I appreciate everybody tuning in, and be good, y'all.